1,700% in just 2 weeks back in January 2021. This unprecedented surge caught the attention of not just Wall Street, but the entire world. This wasn't some hot new tech company. It wasn't a startup with a revolutionary product or a tech giant releasing the next big thing. This was GameStop, a company many thought was on its last legs. The retailer had been struggling for years, closing stores and facing declining sales as digital downloads became the norm. So, what in the world happened? How did a company on the brink of collapse become the hottest stock on the market? Well, folks, it was a wild ride fueled by social media frenzy and some risky investment strategies. Platforms like Reddit, particularly the subreddit Wall Street Bets, played a crucial role in this phenomenon. People were buying GameStop stock like it was going out of style, and the price just kept climbing higher and higher. It was a perfect storm of retail investors banding together, driven by a mix of financial opportunity and a desire to challenge the status quo. Now you might be thinking, Jim, I wish I had gotten in on that action. The fear of missing out, or FOMO, was real, and many people jumped in hoping to ride the wave. But before you quit your day job and bet the farm on the next GameStop, let's take a closer look at what really went down. The story is more complex than just a stock price surge. This wasn't just about making a quick buck. It was about sticking it to the big guys, the hedge funds that had bet against GameStop. These institutional investors had shorted the stock, betting that its price would fall. It was a David versus Goliath story for the internet age, and everyone wanted to be on the winning side. The retail investors saw themselves as the underdogs, taking on the financial giants. But as with any high-stakes game, there were winners and losers, and the line between them was often blurred. Some made fortunes, while others lost everything. The GameStop saga is a reminder of the unpredictable nature of the stock market and the power of collective action. The GameStop saga wasn't just about a company's stock price, it was about the allure of infinite money. The idea that you could turn a small investment into a life-changing fortune. It's a seductive idea, and it's what drew so many people to GameStop. Social media was buzzing with stories of ordinary folks becoming overnight millionaires. People were quitting their jobs, paying off their debts, and living the dream. It seemed too good to be true, and guess what? It was. The truth is, there's no such thing as infinite money in the stock market. Sure, you can make a lot of money quickly, but you can also lose it just as fast. The stock market is a lot like a casino. You can get lucky and win big, but the house always has the edge. And just like in a casino, the more you risk, the more you stand to lose. Now, I'm not here to rain on your parade, but I do want to inject a dose of reality. The stock market is not for the faint of heart. It's a risky business, and you can lose your shirt if you're not careful. One of the biggest risks is something called volatility. That's just a fancy word for how much a stock's price can go up and down. And let me tell you, GameStop was about as volatile as it gets. Another risk is something called FOMO, or fear of missing out. When you see everyone else making money, it's tempting to jump in head first without really knowing what you're doing. But trust me, that's a recipe for disaster. Before you even think about investing, you need to do your homework. Understand the company, the market, and the risks involved. Don't just blindly follow the crowd or listen to some guy on the internet. Remember, knowledge is power. Now, let's dive into some of the strategies that were at play during the GameStop frenzy, which captivated the financial world and beyond. One of the most talked about strategies was short selling, a technique that can be both lucrative and perilous. Short selling involves investors borrowing shares of a stock they believe is overvalued and likely to decline in price. They sell these borrowed shares with the intention of buying them back at a lower price, thereby pocketing the difference as profit. However, this strategy is fraught with risk. If the stock price rises instead of falling, the losses can be substantial, as some hedge funds painfully discovered during the GameStop saga. Another sophisticated strategy that came into play was options trading, which adds another layer of complexity to stock market investments. Options are essentially financial instruments that function like side bets on a stock's future price movements. They provide the right, but not the obligation, to buy or sell a stock at a predetermined price within a specific time frame. This means you can leverage your position and potentially amplify your gains, but it also means you can magnify your losses if the market moves against you. Options trading can be highly lucrative for those who understand the intricacies and are willing to take on the associated risks. However, it's not for the faint of heart or the inexperienced. If you don't fully grasp the mechanics and risks involved, you could end up losing a significant amount of money. potentially more than your initial investment. Now, I'm not suggesting that you should completely avoid short selling or options trading. These strategies can be valuable tools in an investor's arsenal when used correctly. But it's crucial to approach them with a thorough understanding and a well-thought-out plan. Educate yourself, seek advice from seasoned professionals, and never invest more than you can afford to lose. These are advanced strategies that require not only knowledge and experience, but also a high tolerance for risk. Proceed with caution and always be prepared for the unexpected twists and turns of the market. Section 5. The power of the crowd, social media's influence. One of the most fascinating aspects of the GameStop saga was the role of social media. It wasn't just a platform for sharing memes or keeping up with friends. It became a powerful tool for financial coordination. Platforms like Reddit, Twitter, and Facebook became echo chambers for GameStop enthusiasts. These platforms allowed users to share their thoughts, strategies, and predictions in real time, creating a sense of community and shared purpose. People were sharing information, coordinating their trades, and cheering each other on. This collective effort was unprecedented and showcased the power of a united online community. It was a classic case of the wisdom of the crowd, where a large group of people can collectively make better decisions than any one individual. The collective intelligence of these online communities was harnessed to drive the stock price up, but there's also a dark side to social media. While it can unite and empower, it can also mislead and deceive. It can be used to spread misinformation, manipulate markets, and create artificial bubbles. The rapid spread of false information can lead to panic and poor decision-making. In the case of GameStop, there were definitely some bad actors who were trying to pump up the stock price for their own personal gain. These individuals exploited the enthusiasm and trust of the community for their own benefit. Social media can be a powerful tool for investors, but it's important to be discerning about the information you consume. Not all advice or data shared online is accurate or reliable. Don't believe everything you read online, and always do your own research before making any investment decisions. Critical thinking and due diligence are essential in navigating the complex world of social media-driven investments. Section 6. The squeeze is on GameStop's moment in the sun. The climax of the GameStop saga came in late January 2021, when the stock price went absolutely bonkers. It was a classic short squeeze, where the hedge funds that had bet against GameStop were forced to buy back their shares at much higher prices to cover their losses. This buying frenzy only pushed the price even higher, creating a self-fulfilling prophecy. It was a sight to behold, folks. The little guys were sticking it to the big guys, and the internet was going wild. But like all good parties, the GameStop rally eventually came to an end. The stock price crashed back down to earth, leaving many investors holding the bag. The GameStop short squeeze was a historic event, but it's important to remember that it was an outlier. Short squeezes are rare, and they're incredibly difficult to predict or profit from. Section 7. The hangover GameStop and the realities of investing. In the aftermath of the GameStop frenzy, it's important to take a step back and reflect on what we've learned. The GameStop saga was a stark reminder that the stock market is not a get-rich-quick scheme. It's a complex and risky endeavor that requires knowledge, discipline, and a long-term perspective. The idea of infinite money is a dangerous illusion. There are no shortcuts to success in the stock market. The only way to build wealth over the long term is to invest in quality companies, diversify your portfolio, and stay the course through thick and thin. The GameStop saga was a wild ride, but it's important to remember that it was just a blip on the radar screen of the stock market. The market is always evolving, and there will always be new opportunities and challenges. Section 8. Join the conversation. Share your thoughts. So what do you think, folks? Were you caught up in the GameStop frenzy? Did you make a killing or did you get burned? Share your thoughts in the comments below. And don't forget to tune in to Mad Money tonight, where we'll be diving deeper into the world of investing and exploring how you can make smart decisions with your money. Stay informed, stay engaged, and stay bullish.